Welcome to this tutorial on moving averages, one of the most essential trend indicators in cryptocurrency trading. Moving averages help traders identify market trends and make informed trading decisions. A moving average, or MA, is a technical indicator that smooths out price data by creating a constantly updated average price over a specific time period. Think of it as a way to filter out the noise from random price fluctuations and see the underlying trend more clearly. There are two main types of moving averages that traders use: the simple moving average, abbreviated as SMA, and the exponential moving average, abbreviated as EMA. Each has its own characteristics and uses in trading. The simple moving average calculates the arithmetic mean of prices over a specified period. All data points carry equal weight in this calculation. The formula is SMA equals the sum of prices P1 plus P2 plus ... plus Pn divided by n, where n is the number of periods. The exponential moving average gives more weight to recent prices, making it more responsive to new information and price changes. The formula is EMA equals price times K, plus previous EMA times 1 minus K. This weighting system helps the EMA react faster to price movements than the SMA. Traders commonly use three main moving average periods: the 50-day moving average for short-term trend analysis, the 100-day moving average for intermediate trends, and the 200-day moving average for identifying major trend direction. These timeframes have become standard in the trading community. Moving averages help identify trends in three key ways. When the price is above the moving average, it indicates an uptrend. When the price is below the moving average, it signals a downtrend. And when the price crosses the moving average, it suggests a potential trend reversal is occurring. Bullish signals occur in two main scenarios. First, when the price breaks above a moving average, suggesting upward momentum. Second, the golden cross, which happens when a short-term moving average crosses above a long-term moving average. This is considered a strong bullish signal by many traders. Bearish signals are the opposite. They occur when the price breaks below a moving average, indicating downward pressure. The death cross happens when a short-term moving average crosses below a long-term moving average. This is viewed as a strong bearish signal that suggests a potential downtrend ahead. The moving average crossover strategy involves comparing two moving averages with different periods. A common example is using the 50-day moving average versus the 200-day moving average. When these moving averages cross over each other, they signal potential trend changes that traders can use to make entry or exit decisions. Moving averages also function as dynamic support and resistance levels. In uptrends, moving averages act as support, where the price tends to bounce upward. In downtrends, they act as resistance, where the price struggles to break through. Price often bounces off these key moving average levels, making them useful for setting stop losses and profit targets. Let's recap the key points. Moving averages smooth price data to help identify trends more clearly. Use multiple timeframes for better analysis and confirmation of trends. Combine moving averages with other indicators for more reliable signals. And always watch for crossovers and price interactions with moving averages, as these often signal important trading opportunities.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.